One thing that all of us are well aware of by now is that affordability is the #1 issue that is plaguing the housing market. And I came across some pretty interesting information today that pretty much lays it out for us that in order for housing to become affordable again, meaning that people can actually pay the house payment without being completely upside down, is that home prices would need to actually fall by 35%, guys. Conversely, if home prices were to stay where they're at right now, people would actually need to make 55% more money to actually make this current housing market affordable. And obviously, either one of those scenarios sounds probably pretty crazy to a lot of people. But every other time we've seen problems with the real estate market, the path of least resistance is usually prices coming down. The only other way that things can become super affordable again is if interest rates were to drop close to zero, which is not going to happen anytime soon. So it really only leaves prices to come down, and realistically, nobody's going to be making 55% more money in a year from now. And the problem that keeps happening right now is people's purchasing power keeps being dwindled down pretty much quarter after quarter here as we move through the year, because home prices are still too high, but the mortgage rates are actually still going up, which makes it so that your monthly payment is higher than it would have been actually a year ago when home prices were higher than they are right now, which is why a lot of people probably get it confused with, okay, we need to see interest rates coming down in order for affordability to return. But in reality, it's kind of a combination of all of it. It's not like you just need to see interest rates come down in order for affordability to come back. It needs to be some sort of combination of interest rates coming down, lower home prices, and making more money. That's how we get a more balanced market. That's how you get people to move and sell and buy. And we know that people aren't interested in paying these prices or these rates anymore because the amount of mortgage applications just keeps going down. In fact, last week, the mortgage applications hit the lowest level that we have now seen since 1996. Like, how long ago was that, guys? 1996. Think about that. Now, some people will say, well, this is also pulling down supply as well because it makes it so less people are likely to list their homes, which is true. But on the flip side of that, people are always going to list and buy and sell homes, guys, because that's just the cycle of the real estate market, regardless of what's happening. But the thing is, because the demand is so low from buyers right now, that's why we're starting to see inventory tick back up. Because if people cannot afford to buy, they're not going to buy homes. However, the inventory that is coming on the market is no longer being absorbed at the rate that it used to be. And so even though less people are listing homes for sale, that's how we get this anomaly where we get less listings, but inventory continuing to go up. And I believe that's going to be the direction that things are going to be going into the foreseeable future, especially as rates remain high like they are. We're already looking at people getting 8.5% mortgage rates right now today. There's a high probability by the end of this year, people could be in the double-digit territory. And that might have sounded crazy a year ago to people, but now it's our reality. And by the way, I'm over here walking on Spinnaker Point Drive in San Rafael by all these different townhouses they have over here. And don't know if you guys can guess how much these townhouses sell for, but about 1.1, 1.2 million for one of these townhouses. No big deal. The waterfront ones obviously are going to be the expensive ones. Maybe you can get some of these ones that aren't waterfront a little bit less. Yeah, this is the reality over here. Now, there was a woman out of Boston. She has a small business, and you know things are getting pretty crazy when you have people that are approved to take on literally a $1 million mortgage and cannot find a place to live, guys. This girl's only 29 years old. She has her own business. She got approved for a $1 million loan. And she said that she's renting a room right now for only $1,400 per month. And she's also put in about 7 or 8 offers on different places, and none of them have been accepted. Everybody has outbid her, and she keeps losing left and right every time she makes an offer on a place. And this firsthand account pretty much coincides with a lot of what you guys tell me, that how the Northeast when it comes to real estate is still going crazy. And this is kind of like a firsthand account of that. And you know, it's kind of crazy that this whole situation is continuing to happen in the Northeast, where people are still getting outbid, especially when you're qualified to receive a $1 million loan. That's not a cheap house, guys. That's kind of on par with what we're seeing over here. You see, I just told you these townhouses are selling for a little over $1 million. That's pretty much $1 million loan a lot of people would need by the time they put the down payment on this place. And you know, at today's interest rates, just FYI, if you're gonna buy a house that's 1.1 million, for example, like one of these townhouses, that puts you at over $8,000 per month mortgage payment. So you gotta be really raking in the dough to even qualify for this. Say 1/3 of your income is the maximum debt to income ratio a lender will approve you for. You need to be making at minimum $24,000 per month to be able to buy a townhouse like this, guys. $24,000 per month. And yet over in the Boston area, people are buying up homes like this left and right and bidding them up, and somebody like this can't even get an opportunity to get their foot in the door and buy a home, which is totally crazy. And it's funny too, because you know, it's not just the prices, it's the mortgage interest rates that make all this unaffordable as well. You know, and now you have all of the experts saying, well, this time we're going to see mortgage interest rates back down to 5.5% by the end of 2024. Well, that's what they said by the end of 2023. It is nice that they have this waterfront walking trail behind these homes though, and especially on a hot day like today, you get a little bit of the cool breeze coming off the water, and it feels pretty good out here. I love these little walking trails they have along the Bay Area here. But to kind of prove the point that a lot of you guys tell me, like, oh, the Northeast, things are still going crazy, this story is proof of that. When somebody that has $1 million loan budget and they cannot competitively compete and bid on a home, guys, that's when things have fundamentally broken, I would say. And I'm not familiar with Boston. I've never been up there. I don't know much about the area. I just know it's very expensive, and the fact that things are still going on like this is kind of crazy, especially moving into a recession. Now, one thing I'm always harping on here on the channel is high property taxes, because number one, it's an expense that a lot of new home buyers don't realize they're going to have to get smacked in the face with pretty soon when they buy a home. And number two, a lot of this property tax money seems to be just flushed down the drain, because you pay all this money in property taxes, and it seems like none of the services of your local city ever get better. You know, it seems like the extra money that they collect doesn't really go anywhere. Well, one of my viewers, Kent, he sent me this listing from Sunset Beach in Missouri. I've never heard of this area before, but he said he's retiring to this area, and this is the reason why. So he sent me this picture of this $8.8 million mansion that only has a $2,300 per year property tax bill, which is obviously laughable. You know, where else can you find a house in the country that expensive that has a property tax bill this low? I don't know of anywhere. I had to look into this a little bit more to see how realistic this is. So I looked at this $500,000 house, which seems to be more like the regular price houses in this area anyways, and their property tax bill is almost the same at around $2,100 per year. So it looks like the $8.8 million house hasn't been reassessed in a while, but still, even for a $500,000 house to only pay $2,100 per year in property taxes, I don't know of another place where that's possible. Like, maybe there are places, maybe Alabama, maybe Mississippi. It definitely ain't in California or Florida, I'll tell you that much. I even looked at another one just to make sure that this wasn't like an anomaly with these two listings, and you see this house here, $710,000, and their property tax bill is about $2,500 per year. It seems like that's kind of like more in line with reality than this $8 million mansion. I'm sure whoever buys that place, then their property tax bill is going to go up substantially, but it ain't going to be nowhere near what it would be in Miami or over here in San Rafael. Now, I really love this Fairway Mortgage Company because every single week I get their emails, and even though they're trying to get buyers into this market at no matter what cost, for that it's kind of ridiculous. But the part I love about it is these guys just feed me the best content, you know, when it comes to reading these things that I couldn't even make up if I tried. And I love sharing these emails with you guys because it shows you a couple things. It shows you the desperation of where people are at when it comes to closing mortgages and closing real estate deals right now, and the length that people are willing to go to make that happen is what it shows first of all. And the other thing is it shows the creativity involved with trying to convince someone to buy, even in a bad market like this, guys. So check out what they're saying this week. Tip of the week, 95% Fannie Mae 2 to 4 unit properties. What this means for our industry. It says, yes, this is a game changer for so many reasons, more than you think. For starters, although FHA allows 3.5% down on 3 to 4 unit properties, you must pass a self-sufficiency test that no property will pass with rates this high. With Fannie Mae, this is not required. How can you use this to attract more buyers? Think about it this way. If someone wants to keep their maximum payment to a set number, let's say $3,000 per month, every 1 unit property you find for them puts them in the $4,000 per month range. That person might not get off the fence and buy for a long time. But if you find a multifamily property that will pay them rent for the other unit, that will offset part of their payment, getting them at or below their desired monthly payment. Payment on a duplex might be $5K, but if you are renting out one side for $2,500, you are only paying $2,500. In addition, you're building equity, getting tax benefits, and being a homeowner. That works even better on 3 to 4 unit properties. Now, on the one hand, I will agree with Fairway Mortgage that, this is a great way to enter the real estate market. One of the best things that you can do, especially if you're young and single, is to buy a duplex or even a multifamily property, 3 to 4 units like that, because anything under 4 units is considered residential real estate. More than 4 units is commercial. So you have to stay under 4 most of the time in order to make this really work for you. But by doing this, you're allowing other people to offset your housing costs, which is always a good thing. But the part about this I don't like right now is they're trying to get vulnerable people to become a landlord that have no experience, because most people who are landlords are probably not going to be doing this right now because the return on investment is not there. And you're not going to buy a property that doesn't have a return on investment. However, they're trying to target vulnerable home buyers that are desperate to buy a home into buying one right now and using landlording and house hacking as a good excuse to do so, which to me is kind of crazy, guys. Like, this is not for everybody, trust me. Even though you can actually make a good deal and actually, have somebody else pay part of your mortgage, that's not what most people should be doing, because most people aren't going to have the time and energy or know-how to manage something like this. Also, what if there's a vacancy? Okay, that's the other thing people need to think about. And especially in an economy like this where there's lots of job losses happening, things are probably going to get a lot worse, not better from here. Where do things go? Well, I'll tell you where it goes. It puts you, who wanted a $3,000 a month payment, into a $5,000 per month payment duplex, and as soon as the other unit goes empty, now you're paying $2,000 a month over what you thought you were going to be paying if you can't rent it out. Or if the rent goes down because there's too many rentals on the market, then maybe the property doesn't pencil out anymore the way you need it to. Say rent goes down to $1,800, now you're still over budget paying for this duplex, and you're paying more than you would be paying with your single family unit, having to fix all the problems and deal with tenants that come along with it, guys. So this is not really a good solution for people that are desperate, okay? It's good for people that want to become real estate investors and are thinking about buying their first home, and this is the first ring on their belt. But this is a horrible time to be doing something like that, because you're paying basically a record high price for the property and getting a high interest rate to go along with it. It's not going to become a very good investment property in the future if you ever want to move out and turn it into a full-fledged cash flowing property. Because the thing is, Fairway Mortgage is making up numbers here. They're saying, okay, you would have a $5,000 per month mortgage, and assuming you're going to get $2,500 a month in rent for the other side is pretty generous. And they're not even factoring in things that are like expenses, property taxes, insurance, all these things that end up raising your payment even higher, guys, because they're quoting these payments of just your mortgage payment. So if you ever want to move out of this property and turn it into a full-time investment property, there's a high probability that your monthly expenses will be higher than your rent. Okay, because let's say even if you could get $2,500 per month for both sides, that's $5,000 a month, assuming no vacancy and no expenses, which is a fantasy in the landlording world. It's impossible for that to happen. You're going to have vacancy at some point, you're going to have repairs, you're going to have maintenance costs, things like that crop up. But let's say in a perfect world, you're getting that $5,000 per month, but your real expenses are probably going to be more like $6,000 a month after you pay property taxes and insurance and repairs and whatever else comes along, utilities, because you're going to be paying the utilities as well for the duplex. That might work okay while you're living on one side of it, but the day you want to move out and turn it into a full-fledged rental property is the day that that place starts negative cash flowing. And that's not a good position to be in as a landlord. So that's my issue with it. I'm not saying that the idea of buying a multifamily and getting into it and have somebody else paying part of your bills is bad. I'm saying that now is probably not the right time to do that unless you really find something that does pencil out and make it so that even if you were to turn it into a full-time investment property and move out of that other unit one day and you can still cash flow, then maybe it's okay to go for it even at these prices and rates. But that would be the only circumstance that I would say, yeah, go for it. And the other psychological trick that they're using here, guys, is they're trying to get people to jump in to an even higher payment situation than they even wanted to begin with. Somebody who wants a $3,000 payment isn't going to qualify at these rates because their payment would be $4,000 and that they wouldn't buy for a long time. But they're saying, yeah, get them to buy right now and jump into this landlording situation. So the key to this housing crisis is solved, become a landlord and it's all is well in the world. This is insane, guys. So I just couldn't even make this stuff up. Every time I see these weekly newsletters and the things that they're coming up with, I gotta hand it to them. They're being extremely creative to stay in business and figure out different ways to put these deals together that I never would have thought of. You have to at least hand it to them when it comes to that. And the other thing is nobody's twisting anybody's arm to buy. So if you go for a deal like this, you can't just sit there and blame your mortgage lender or your real estate agent for getting you into the deal, because at the end of the day, it's up to you to decide to move forward with this in the end. So don't fall into the pressure. If you're feeling pressured to do it and you don't really want to, then back out. Okay, it's that simple. Who cares what they think? Who cares if they thought you weren't serious or say something bad about you? It's your money, guys, and it's your life, so don't screw it up. Now, I saw this comment the other day from one of my viewers, Sonia, and I was happy that she shared this with me because it might mean that it's not the end of the world when it comes to insurance in Florida, at least not yet. And what she said is that she's a property owner in South Florida, and she is getting drops from Citizens. She said she just got the letter in the mail and she has a choice of 2 providers. I must switch by November 6th. First option is for $4,082 a year, and that's with homeowner's choice, or Slide Insurance is offering her a deal at $11,000 a year. Oh, what a bonus and tough choice there, huh? But she said that it's actually $800 a year less than her annual premium with Citizens, and she thought I might be interested in that. And yes, I am, Sonia, so thanks for sharing that, because I'm happy to hear that you're saving $800 a month now, that Citizens is dropping you, and that's good news, especially for all my Florida people out there who might be getting this letter in the future as Citizens continues to try to drop people. And the fact that she's saving money is great, guys, and maybe, just maybe, this new bill that Florida passed earlier in the year to essentially make homeowners insurance cheaper again by allowing more competition and more homeowners insurance companies to come into the state, maybe this is a one real life example that it could be starting to work. But I am still very skeptical because I've heard far more negative stories about this than positive ones in terms of how many people are having their insurance rates go up by 20-30%, and there's nothing they can do about it. They have to take that new insurance whether they want to or not. Now, earlier I mentioned briefly mortgage applications have dropped to the lowest level that we've seen since 1996. Well, besides that, we also have 30-year mortgage costs at the highest level that we've seen since the year 2000. And the crazy thing is, guys, this is probably going to continue to get worse. We're going to see higher and higher rates because right now the Treasury yields are just continuing to go up. Right now you have the 10-year Treasury at a 16-year high, also around 4.77%. This is because investors are freaked out And the 10-year treasury moves in tandem with mortgage rates. So the higher that this goes, the higher we're going to see mortgage rates go. Basically, the bond market is having an all-out crash right now. As the Fed continues to hike rates, which they're likely to still do at least one more this year, especially after the most recent jobs numbers and everything came out. This is going to continue to make treasury yields go up, and it's going to continue to make mortgage rates go up along with it. I believe that this whole situation is going to just, in the end, lead to further inventory buildup on the housing market, because we're already starting to see inventory rise at a time of the year when traditionally it goes down, because the absorption rate is not there. People aren't buying these houses because they can't. And the higher these rates go, the more of this we're going to see. And the problem is, it doesn't stop people from listing houses, guys. Like, if somebody needs to sell for whatever reason, then they'll have to list it for sale regardless of what's happening with mortgage rates. And if that's not enough to sell it, what are they going to do next? Cut the price. So something for you to think about here of what could be coming down the line. So if you enjoyed this video, make sure you subscribe to the channel. And if you don't want to wait for my next video to come out, check out this one on the screen right over here, and I'll see you in the next one.